We have three potential major opportunities you will not want to miss. One stock is the undisputed king of digital payments, growing at 21.5% annually. The second stock has $30 billion in cash and skyrocketing revenue. And the third stock has 40 million loyalty members. Now, the best part is they all seem to be undervalued. Guys, the first stock we're going to talk about right now is PayPal. I own it, but don't buy a stock just because I or anybody else on the internet or even Warren Buffett owns it. We're here to teach a process. Let's get into it. Big fall from grace, over 80% drop, but fundamentals getting better. This is what's important when you look at companies. What's the story on PayPal? PayPal is the king of online payment processing. If you're making a purchase online, chances are you've used it. Now, here's the big mind blower. PayPal's been making some serious cash, earning an average of $1.08 per transaction. And guess what? Since 2018, their total payment volume has been growing 21.5% compounded annually, which adds up to a total of 164% increase. Now, when I hear people talk about PayPal is dead, I look at that and think, yeah, they're just talking about the stock price. They're not talking about the business. And the growth is not slowing down anytime soon. As transaction volume rises, so will the money that PayPal pulls in each transaction. And get this, half of PayPal's users are in the sweet spot of 18 to 39 years old. So you might be wondering, well, why is that important, Paul? Well, this age group is when people typically start spending more in their lifetime, which means more money for PayPal in the years to come. So yeah, PayPal is not just dominating today. It's positioning itself for massive growth in the future. And if you're not watching them, I truly believe you're missing out on a company with a lot of potential. But of course, it's all about implementation. We can't just assume because the story is great that they're going to implement great. They have a new CEO that came on last year, and so far things have been getting better. But of course, they also have Venmo, which is a huge app for people making payments to each other, and that is incredible. So guys, some of the other things I love about PayPal, free cash flow, last year $7 billion, last 5-year average is $5 billion. And look at their net income, significantly lower. For those of you who are new to this channel, we love when free cash flow is greater than net income. We love this. So to me, I look at this profit margin of 14%. I say, well, their free cash flow margin is much higher. And you can see it right here. Their PE is 19. Their price to free cash flow is 12. And guys, that's after skyrocketing from that low of the low 50s. They're now at $82 a share. Let's check out the 8 pillars and see what story this tells us. Guys, this would be an 8-pillar thriller if it wasn't for this PE. And again, I'm not worried about the PE because of the fact that their free cash flow is much greater than their PE, than their earnings, net income along the way. These are the things I want to see and a growing return on invested capital. So I'm looking at saying, okay, are there issues? Yes. The number of active accounts had decreased in the last 2 quarters, but the transactions per account had skyrocketed. So yes, you had less accounts, but the people who already had accounts were using it more. That's a really good benefit to the company. So what do analysts think about PayPal? Well, it's not as rosy as your Uncle Paul makes it out to be. According to analysts, they expect $4.50 in earnings this year, growing to $7. Again, earnings is net income, not free cash flow. That's a big difference, but some solid growth here. Revenue-wise, 7 to 10%, 7.8, 7.8, 7.5, 8, 10.6. Again, these are analysts, and I look at this saying, their gross margin's like 50%. How are they growing revenue this much and not growing earnings per share and free cash flow by at least that much? That's what confuses me. So it makes me wonder about this thing. So we have all this information. What do we do with it now? Well, we put it in our stock analyzer tool. And remember, guys, the stock analyzer tool is our final step before we decide if we spend more time in a company or not. Now, I'm not saying to beat yourself down and go do a ton of stocks and go analyze like crazy and all this stuff. But the stock analyzer tool is so great because we know that every investment is the present value of all the future cash flow we're going to get. If you paid $10 for something today and you get $2 a year for the rest of your life, that's a pretty good return. There's going to be a certain return there. That's what we're trying to do here. But because the future is unknown, because humans make mistakes, we need to make different assumption levels, low, middle, and high. I love using this. Now, it's going to give you a very wide range of values, but that's the point. We want to buy when it's a great quality company that's selling at a good price based on our assumptions. So I did 4, 7, and 10% revenue growth for the next 10 years. I did 12.5%, 14.5%, and 16.5% profit margin. But remember, I'm more focused on free cash flow. I did 16, 20, and 24. And this could end up being too low, but we'll see. Now for PE and price of free cash flow, I look at this increasing ROIC. This means as time goes on, this company is getting better at managing the money and getting a return on the money that's in the business. That's a good thing. That's a great thing. And it deserves some sort of premium. So I did 14, 17, and 20 for both my low, middle, and high PEs and price of free cash flow. And finally, my 9% return. Guys, that's the market return. I put it in there to figure out my intrinsic value for the business. But I need a margin of safety. So I recommend putting a higher number in here, higher than 9%, because the higher your return, the lower the price. And that's your margin of safety. But that's going to depend on you. You might know PayPal way better than I know it, or way better than somebody else in the community. That's why when we see people in the community sharing these screenshots, it'll be people saying, well, I think you should go higher because of this or lower because of this. Different people have different circles of competence, and that's what's important. So we hit the analyze button. The stock's currently $82 a share. We have a low price of 60 to 80, high price of 160 to 230, middle price of $100 to $140 per share. Based on today's price, if my middle assumptions are correct, I'm going to get about a 16% return on my money based on free cash flow. I like that. Now, if I could find 30 companies that have this kind of return potential, some will do better, some will do worse, a lot will do somewhere around there, and I'd be very happy with that return. Stock number 2, Alibaba. Another stock that I own that you don't want to mimic, especially with China and the fear around China. $320 all-time high back in 2020. Hit a low in the last 12 months of $67. It got as low as $58 in the recent drop over here. I look at a company like this that's getting beaten up, and I look at their income, and I just look at increase in revenue. 52, 71, 100, 120, 121, 132. Last 12 months, 132. Their net income is a lot lower than their free cash flow. Free cash flow average in the last 5 years of $20 billion, net income of $14.5 billion. $19 billion of free cash flow in the last year versus $10 billion in net income. Guys, they're also buying back a ton of shares. I used to be critical of China and worried about the authenticity of the results. But I look at this saying, if these guys are scamming, why would they report a higher free cash flow than net income? On top of that, they're buying back a ton of shares. Again, why do that? Then I hear people talk about ADRs. Paul, you don't really own the company because... Great, that's always been the case for China. To me, that was just proof that people, because I started hearing that complaint right about there. Because people were following, giving any reason why the stock price could be lower. Now, I personally called Merrill Lynch. I said, guys, if Alibaba gets delisted in the US, what happens? They said, well, your shares will be converted to Hong Kong, and if you ever liquidated, it just might take a little bit of time to get your money. I said, that's it? I don't lose the shares? No, you don't lose the shares. Now, that's Merrill Lynch when I spoke to them. Most spoke to Charles Schwab. These could all be different things here, but it's something to very much understand before you make a decision based on it. Now, let's look at the 8 pillars for this company. All right, 5 checks, 3 X's. Net income growth, we already talked about net income not being great. I don't like this free cash flow drop on $56 billion in revenue. So don't get me wrong, this does kind of concern me right here from this standpoint. I'm looking at going, man, they increased their revenue $56 billion and their free cash flow dropped $2 billion from it. Now, let's go back and see in their cash flow statement, did they increase their capital expenditures? Well, not really. $4.2 billion in 2018, 4.6 last year, 4.8 the year before that, 7.5, 6. So you look at this going, okay, they've been pretty good about their, it's not like they had some big jump like Amazon. Amazon has these massive jumps in capital expenditures as they reinvest back in the business. Now, the story on Alibaba, earnings have shot up from 3.3 billion to 9.7 billion. However, revenue has absolutely exploded from 10.6 billion to 130 billion. And as we saw in our cash flow statement, 4.7 billion to $21 billion. That's a 4X of their free cash flow, yet the stock is only up from $72 to $100 right now. Now here's the kicker. Alibaba has $30 billion in cash with a market cap of $220 billion. And guess what? They've been ramping up their stock buybacks like crazy. which means they're buying back their own shares, as I said earlier. A strong sign that they believe the stock is undervalued. Now, of course, we see stock buybacks on companies at very high levels, but go look at when Alibaba started their buybacks. It wasn't until their stock plummeted. But it gets even juicier. The reality is that the current price of Alibaba stock has very little to do with the company's economics. It's more about that geopolitical noise that's got investors spooked. Look at all the China companies out there. They've all been pummeled. But guys, let's talk about China. There's obviously a lot of chatter about an economic slowdown. But guess what? President Xi seems to be following Jerome Powell's playbook and cranking up the stimulus. No different than we're doing here. We're also discussing a country where the average person makes $12,000 or $14,000 a year, while in the States, we're making $70,000 to $80,000 a year. There's a lot of growth potential there. We're talking about mortgage rate cuts for more affordable housing and a $42 billion investment into their housing projects over there. They're not sitting idle while these things slow down. Remember, a Chinese recession doesn't mean a contraction. It just means a much slower growth rate. Now, for delisting, as I said earlier, the fear is there. In 2022, the US and China came to an agreement that allows for audits of Chinese companies. That was a big issue before. Now, this means that over 200 Chinese stocks, including Alibaba, can keep trading on the NYSE. Now, the organization that looks over all of the auditing, the US PCAOB, is on track to continue those inspections through 2025. So again, is there a delisting worry? I'm sure there is. The question is, has it been factored in too much in the stock price? The bottom line is, Alibaba is crushing it as a business. China is set to add 80 million new middle-class consumers between now and 2030. And that's a ton of potential. Look at it this way. It's the fastest growing middle class in the world. The US is 70% GDP is consumer spending. Once we get there with China, how big will China be? And this underperformance in the stock price, again, it's perceptions. There probably is a lot of reality to those perceptions, but the question is it factored in already into too much? So the real question is, do you want to let all this noise distract you from a potential multi-bagger that could be coming as the China story unfolds and gets better? That's the question you have to ask. Again, I'm not telling you that you need to go buy Alibaba. And if you are scared to death of China, please stay away from it. But you've got to remember that the potential reality versus the price of the stock probably isn't in line. And we have to sit there and realize that even if there's a 1 out of 10 chance that you're right, but if it's going to pay out 20 to 1, I don't know if that's the case here, but if it's going to pay out a huge number, you got to think about that. Now, let's go look at analysts and what they think about everything. Very little growth. $8.90 a share to $9.22 per share. Blows my mind again. But again, in order for a stock to be down a lot, there has to be some sort of perception that things are worse than they actually are. Now for revenue, interestingly enough, 8%, 7%, 8.5%, 7.5%, 7%, 3% growth. Yes, it is not very fast. And this is all the more reason why when stocks are growing fast because their revenue is fast, remember that it doesn't take much for that revenue growth to plummet. But I look at this saying, is this dying 134 billion to 185 billion? Hardly so. And that's why I sit there and have to understand that the stock analyzer tool is so important for that exact reason. Let's go pull it up in stock analyzer tool and look at my assumptions here before we get all bent out of shape about what's going on with Alibaba. So guys, I did really reasonable assumptions. 3, 6, and 9% revenue growth. Nothing huge. It's actually lower on the middle scale than the analysts even have. Profit margin, I did 12, 15, and 18%. Free cash flow, I did 15, 18, and 21. And look at this. In the last 10 years, their free cash flow has been about 21%. But they're spending a lot more money now than they did back then on their cloud systems, their capital improvements, et cetera. PE, I did 16, 18, and 20. Now, this one I could understand if somebody said, well, Paul, I got to go lower, or make your desired return, your margin of safety much higher. And I did 9% there. Now, guys, this is why our software in our community is so important. It's about getting in there. We have a China chat in our community right here, a chat specifically related to China that people have a conversation in. So if you've gone to try to sign up, I'm sure you've noticed that there's a wait list on everythingmoney.com. And the reason for that is today's software includes everything that we have to offer, all of these tools for retirement, stocks, and real estate. But behind the scenes, we're making changes. So that offer is going to go away very soon. Now, if you've been part of our channel since the beginning, you'll remember I built this software in an Excel sheet selfishly for myself so that my team and I could use it to continually help make better investment decisions for myself, for stocks and real estate. But as we've grown, it's less about me and more about how I can better serve you and the other community members. And this is why we do constant updates to our software. We want to make sure we're giving you exactly what you need. Now, the good news is these changes are still being worked on. We're trying to fine tune more and more. So if you join today, you'll be grandfathered in for life with all of these tools, everything here. And in all likelihood, it's the best deal that we have offered, and maybe we even will offer in the future. And I'm telling you this now because there's still time for you to sign up. As long as you join the Everything Money community before we make these changes, you can keep your plan even after we make these. You'll keep all of these tools. You'll be grandfathered in for life, and you'll be locked into your pricing tier forever. So click on the link in the description below or go to everythingmoney.com/sign up and get access to everything we have to offer. It'll probably be the best decision you've made all year. Now, for the stock analyzer, we hit the analyze button. This is why this company is interesting. Low price of 100 to 130, high price of 280 to 330, middle price of 175 to 200. Again, guys, based on my middle assumptions, I have a 20% cash flow return based on those middle assumptions. I don't know if it's going to happen or not, but I like the potential juice coming out of that squeeze. That's what's more important for me. And if I could find 30 companies like this, I would probably do pretty well. Final stock, another stock that I own, and again, don't own it because I do, Ulta Beauty. Ulta is incredible. Warren Buffett recently bought it, or at least Berkshire Hathaway did. I don't know if it was Warren Buffett directly. And it skyrocketed from 320 all the way to like 370 or so. 52 all-time high of 575 was earlier this year, just 8 months ago, 575. 52-week low of 318. Then it was announced that Buffett and Berkshire bought some. It skyrocketed immediately. Guys, this is an $18.5 billion market cap retail business with $21.5 billion in enterprise value. That $3 billion difference is essentially their debt. But guys, look at this. They have $1 billion in free cash flow last year. They have $890 million in 5-year free cash flow. They can easily afford this debt. And it's retail. That's the incredible part. Now let's go to the 8 pillars to see what story this is telling us. 8-pillar thriller. Remember, guys, you don't buy a company just because it has all 8 pillars, and you don't avoid a company because it has more X's than you'd like. But it tells a story here. What's the story here? They get a great return on money invested in the business, high return on invested capital, buying back shares, hopefully intelligently. It might seem that way. Growing revenue by $5 billion led to $500 million in free cash flow growth, and reasonable prices of their 5-year PE and 5-year price of free cash flow. I love gross margin, 39%. Profit margin, consistently in the 10% range. So guys, I'm looking at this saying, it doesn't feel like retail, even though it's retail. It's not struggling. So what's that story? Guys, I would consider Ulta Beauty the undisputed heavyweight of the beauty world in the US, and they're absolutely smoking it. They have 600 brands and 25,000 products under their roof. Ulta is a one-stop shop for all things beauty, and it doesn't just stop there. They have over 1,400 stores nationwide. They've got a presence in every single state. That is called reach, guys. They're out there, but with every single state, only 1,400 stores. I love that. They're smart about their growth. Now, here's where it gets absolutely insane. Like I said in our intro, they have 40 million loyalty members. They have 40 million people that are already hooked to their brand. And the numbers don't lie. Since 2013, Ulta's earnings per share has been growing at 24% compounded annual growth rate. And they're bringing in a solid $10 billion in revenue. And even more impressive, 20% of that, $2 billion of that, comes straight from online sales, which is a massive win in the world of retail right now. Now, a big reason for Ulta's success is their constant reinvestment in their brand. In the last 3 years alone, they've added a whopping 95 new brands to their lineup and increased spending on these brands by 35%. And the beauty market, it's on fire with a runway for insane growth that shows no signs of slowing down. Guys, the vast majority of our viewers are men. So for the men out there, how many of your spouses, girlfriends, wives, friends who are female go to Ulta Beauty? Ask them next time. And for the women out there, how often do you go to Ulta Beauty? Every time I see an Ulta, I just walk in to see what's going on there. I love how clean it is. I love how nice it is. The women in there are very nice. I love the whole experience. And I think Ulta is actually set up to keep compounding for a very long time. Add to that, they're top tier brands that rank among the most used and most loved in America. And you've got a company that's in prime position to dominate for years to come, even in a tough retail environment. I truly believe that if you don't look at Ulta, you're missing out. Now, you might see something I don't see. Any of you in the community, by all means, mention it to Dalton, mention it to myself, because I want to hear what your viewpoint is. So what do analysts think about Ulta? They might be wrong. $26 earnings per share going to $42 per share. 11% even, 10%, 10%, 17%, 13%. All across the board, but it's pretty clear they think EPS is growing nicely. Revenue growth, nothing sexy. 12%, 3%, 6%, 6%, 7%, 6%. That's pretty solid though. You're going to get growth from inflation and you're going to get growth from new store sales. So let's break this thing down in our stock analyzer tool and see what Ulta looks like from that perspective. So guys, I did my 10-year analysis, 3, 5, and 7%. And one thing to point out, ROIC in the last 10 years is 20%. Last 5 years, 22.3. Last year, 28. They're getting better at making money that's invested in the business. Munger will always say, if you can find a company like this, even if it sells for a major discount to the multiples in the future, you're probably going to get a pretty good return on your money. And that's my bet on Ulta. Profit margin, I did 9.5, 10 and a quarter, 11. Free cash flow margin, I did the exact same thing, even though their free cash flow has trailed their net income a little bit. PE, 15, 18, and 21. I went a little bit lower because of the fact that they're retail. And some could argue, put in the right PE and then put a higher desired return. That probably is a smarter move. But again, I'm doing my 9% desired return to match the market. And guys, after this, if you want to see my stocks at 52-week low video, make sure you watch it. But here are the numbers on Ulta. Hit the analyze button. I have a low price of $346, high price of $670, middle price of $484. And today's price yields about a 12% return on my money. Guys, see you in the next video. Stocks to watch at a 52-week low. Thank you for your time.